right. Hopefully, if everyone can still hear us, if you could, someone just raise their hand or put something in the chat, let us know that you're, oh, very good. Very good. Thank you so much. Thank you all for your patience. I am Wendy Goswich with VIP Mortgage, and we appreciate you guys joining in for today's webinar. We are especially appreciative of your patience. We're sorry we got a little late start here, but thanks for spending some time with us this morning. We hope that you're able to walk away with some helpful information about how a reverse mortgage may help you or someone you know. Today's presenter is Rick Rodriguez. Rick is the National Director of the Reverse Mortgage Division at VIP Mortgage. Rick's been specializing in reverse mortgages since 2005. He's consulted with thousands of homeowners, as well as real estate agents, financial advisors, and other professionals regarding the role that housing wealth can play in retirement planning. In his role here at VIP Mortgage, Rick helps lead the company's reverse mortgage division, and he works with teams across the country to support education and collaboration with homeowners, as well as all of our financial related industry partners. I'd like to now introduce you to Rick Rodriguez.
Good morning. Thank you, Wendy. And good morning, everyone. And once again, we apologize for the technical difficulties. There's been a wind advisory out here in Las Vegas. I don't know if that's the culprit, but we are on, and we, again, appreciate your patience. As Wendy mentioned, our team focuses exclusively on reverse mortgage education and helping homeowners understand how housing wealth may fit into the retirement plan. Before we begin, I want to be clear about today's purpose. This is an educational session. We're not going to be asking you to apply for anything. No decisions need to be made today. This is going to provide you with a lot of information. Unfortunately, there's a lot of misinformation surrounding reverse mortgages. So our goal this morning is simply to provide some clarity. We're going to walk you through some of the challenges that many retirees are facing today. How reverse mortgages actually work, some of the built-in consumer protections, and the different ways that housing wealth can potentially be used strategically in retirement. By the end of this session, our hope is that you'll have a clear understanding of how these programs function and whether there's something worth exploring for you or someone you know. So let's get started and looking at the most common landscape here of retirement and some of the challenges that are facing retirees today. And well, 44% of Americans right now who are age 60 to 70 are presently carrying a mortgage into retirement. And according to this post from the Washington Post, 70% say they may never pay it off. So that's something that we're concerned with, which is mortgages that may be in place for the rest of many Americans' lives. And what are some of the worries in retirement? Well, number one is outliving your retirement savings. That's what we're all working very hard and trying to do right now, is for those who are not in retirement, is to have enough money saved up so that we don't outlive our savings. Of course, market volatility and inflation are important topics in retirement. How to pay for healthcare costs, financial shocks. Certainly, anything that happens in the economy, that could certainly be a shock to someone in retirement who has a limited amount of income and savings. Preserving legacy. And we just talked a minute ago about still carrying a mortgage and other debt in retirement. And for many, of course, one of their biggest worries is they want to be able to continue living comfortably in their home. So what are some of the statistics that are going on with baby boomers? Well, at the moment, there are 10,000 Americans who are turning 62 every day. And for many of these Americans, unfortunately, they're just working on Social Security income. There's fewer pensions and defined benefit plans than we used to see years back. And we've seen some of the lowest return on investments in decades, which for people in retirement who are relying on that nest egg, that can be catastrophic for some of them. So as a result, research at Boston College has indicated that 76% of Americans plan to delay retirement. Why is that? Well, they're not confident that they're going to have enough savings to last them the rest of their life. And let's not talk about long-term care insurance, because that is another hot button that only 7% of us have it, but 70% of us are going to need it one day. So that's something certainly that we have to consider and talk about more in this country, is the need and the affordability of long-term care insurance. So for many of our baby boomers, there's a greater need for security and certainty than ever before, because on the bright spot, we're living longer. Advances in medicine and technology are allowing us to live longer. However, we've got to find ways to sustain that additional life comfortably. And the bright spot is that majority of baby boomers do have equity in their home. And from the last report, presently in this country, for homeowners over the age of 62, there is approximately over $14 trillion sitting right now in home equity. And as far as some of the research, we always like to lead with research when we talk about this product and how it can be used in retirement planning. And the CEO over at the National Council on Aging said, for most people, the use of home equity is no longer a question of if, but when and how. Jamie Hopkins, a financial services advocate, said not including home equity and reverse mortgages in the financial planning process is the largest failure of the financial services profession at this time. That was a quote that was in Investment News a few years back, where Jamie Hopkins was speaking directly to his colleagues, his industry, the financial services industry, other financial planners, and letting them know that, in his opinion, they've been failing in their fiduciary duty of not including home equity in the discussion of the retirement plan. So, what are reverse mortgages and how could they potentially work in retirement planning and aiding with some of these retirement worries that we discussed? Well, let's talk about the basics. A reverse mortgage is a home secured loan designed for older adult homeowners. It enables a borrower to convert a percentage of your home's equity into tax-free cash. There are no required monthly principal and interest mortgage payments. A reverse mortgage is an optional payment mortgage. However, the borrower must continue to pay property charges such as property taxes and homeowners insurance. The most common reverse mortgage is the home equity conversion mortgage. This is the one that was put in place back in 1989, and over 1 million Americans have used the HECM since. Presently, it is insured by the Federal Housing Administration, and it has a maximum limit that the borrower can borrow against their home of $1,249,125. Since its introduction in 1989, there have been many amendments over the years to improve the product, make it more secure, and offer more options to the consumer. There are also proprietary reverse mortgages as well. These have come about in recent years to offer solutions that the FHA product may not be able to offer. For example, this product has a much higher limit. Unlike the FHA product, we can lend up to $4 million in loan amounts and property values of $9 million. This originally was called the jumbo reverse mortgage. However, it's also filled other voids, such as allowing non-FHA approved condos, as well as offering this to people who are 55 or older. Unlike the home equity conversion mortgage, where you have to be 62 or older, this one has a lower age requirement. And it also recently introduced a second lien reverse mortgage. This is something that we never had previously until just beginning of this year. So there's now a proprietary second lien reverse mortgage that allows you to keep your first lien mortgage intact if you so choose, and put a second mortgage, reverse mortgage behind it, where same rules apply. There's no required payments. So some of the basic requirements of a reverse mortgage. The main requirement is age. One has to be at least 62 or older for the FHA reverse mortgage and 55 or older for the proprietary reverse mortgage. You must be the homeowner. So this is not for investment properties or second homes. These are for primary residence homes, and only the homeowner can be on the loan. There are minimum credit and income requirements, just like any other mortgage loan. Though it's much easier to qualify for a reverse mortgage, nonetheless, there are credit and income requirements that one must meet. And the properties that are available for a reverse mortgage, well, pretty much any type of property, single family residences, 2 to 4 unit properties, condominiums, townhomes, modular homes, and even manufactured homes that meet FHA requirements. So pretty much any home you can put a reverse mortgage on. And so here's some of the protective features of the product. The protective features are the non-recourse feature. So what this allows is it removes the personal liability from the homeowner as well as the estate. In fact, reverse mortgages don't even show up on one's credit because you're not personally liable to the debt. This is the non-recourse feature of the product. You nor your heirs would ever owe more than the value of the home at the time of repayment, assuming that if the balance were to rise higher than that, which we'll talk more about that here later. Borrowers must receive counseling. So this is a very important step in the product. Aside from working with a lender, the borrower must go through a third-party counseling service to ensure that they understand how the reverse mortgage works, and the industry also wants to make sure that the homeowner is of right, sound mind to enter into a financial transaction. There are initial disbursement limits to help better manage the funds that are available with the reverse mortgage. We have a financial assessment, which is the credit and income qualification portion of the product. And non-borrowing spouses are also protected, which we'll talk about that a little bit later as well. And perhaps one of the biggest features of the reverse mortgage is the line of credit. It's a secure line of credit that can always be in place, even if property values may decline or there's changes in the economy, and the unused portion of the line of credit grows, which is perhaps one of the most important aspects of the reverse mortgage, and we'll cover a little bit more in depth here later. So how can you extract what is available as a reverse mortgage loan? Well, of course, you could take a lump sum cash, which is very common with traditional mortgages. I can take a cash out at the closing of the loan. But in addition, the reverse mortgage gives me 2 other options. I can also take the loan amount that I qualify for as monthly payments, or I can also have it placed in a line of credit, similar to like a home equity line of credit. I can also do a combination of any of these. For example, I could take a lump sum of cash out at closing, and then the remainder that's available I can have placed in the reverse mortgage line of credit. Now, how much can I qualify with the reverse mortgage? Well, the money available depends on, number one, the age of the youngest borrower, the interest rate of the loan at the moment, and the lesser of the home value or the HECM loan limit, if it is a HECM type reverse mortgage, which currently is $1,249,125, or of course, if it's a proprietary, the maximum, as we stated earlier, is $4 million. So these are the factors that determine how much you can qualify from a reverse mortgage. And to give you an idea, at different interest rate environments, this chart shows you, as you go across here, you see the different interest rates from 5 to 7%. And then as you work your way down, you see the different ages, 62, 65, 72. We just took a couple different examples to give you. So as you can see, the percentages in the middle of this chart are giving you an idea as how much you could qualify or someone could qualify for based on their age and where interest rates are at. The rule of thumb is that the older you are, the more you qualify. And the lower the interest rate, the more you qualify. So in this example, if you have a home of $700,000 that's safe, free and clear, and the youngest borrower's age is 72, and we're in an interest rate environment of 6%, which is about where we're at on this product today, this person would qualify for 41.6% of the home value. That is a maximum loan amount, reverse mortgage loan amount of $291,200. So that percentage could be applied to any home value or even a purchase price of a home to provide you how much a reverse mortgage loan is available. Now, when is the reverse mortgage due and payable? Well, of course, once you sell the home, the reverse mortgage must be paid from the sale of the home. If you transfer title to someone else, if you're no longer going to be living in that home, then that's when the reverse mortgage is due. When the last surviving borrower moves out permanently, so if, say there's two borrowers and one borrower passes away before the other, the surviving borrower continues on with the reverse mortgage without any changes whatsoever. And then once that last surviving borrower is no longer living in the home, this is now when the reverse mortgage is due. If there's any default on the loan terms, this could cause the reverse mortgage to be due. The default would be if you're not maintaining your primary residency and if you're not paying your property charges. That would be your property taxes and homeowners insurance. This is the only way that you can default on a reverse mortgage, assuming too that you're keeping your property in good condition, of course. Now, what about different maturity events that can occur that will cause this to be due and payable? So, for example, if the loan is not yet due and payable, the borrower can pay as much or as little toward the loan balance each month. So remember, this is an optional payment mortgage. A lot of people don't realize that. They just assume that there is no payment on a reverse mortgage. But it's an optional payment mortgage. So in one's lifetime, they can elect to make payments, or they have the option of never making a payment for as long as they're meeting the terms. Primary residence, paying taxes and insurance, and making sure the property is kept up. Now, the loan is due and payable. At that point, it must be completely satisfied in full. It cannot be assumed by anyone else. So it's either going to be by the sale of the home, or if there is other means of paying it off, such as maybe cash and inheritance or another type of mortgage to pay off the reverse mortgage. And what about the heirs? Well, once the borrowers pass away, assuming that they have hopefully like a living trust as an example that is going to state who is going to obtain title of the home at that point, then the heirs would have a decision to make. And certainly whether there's equity or not is probably going to weigh into the decision of what they want to do with the property. So for example, if there is still equity, equity left, then they might want to pay off or refinance the loan balance to keep the home. Otherwise, they might just decide to sell the home and then take any of the profits once they pay off the reverse mortgage. If there's no equity left, the heirs are protected. If they want to purchase the home, they would not be required to pay what is owed, but they would only be required to pay 95% of what the value of the home is at that time. So this is only in a situation where there's no equity, the home is upside down, which is not common, but could happen depending on what real estate does. In that scenario, they're given this option. If they want to retain the property, again, they can buy it for less than what is owed. Or if they don't want to retain the property and they want nothing to do with it, they can simply sign a deed in lieu of foreclosure and walk away from the home. And essentially, the reverse mortgage lender would then take charge of selling the property and liquidating. Let's talk about how this product can be used in different retirement planning strategies. Well, we always like to lead with research, and these are three gentlemen that have done a lot of research on reverse mortgages over the years. These are three gentlemen who are not in the reverse mortgage industry. They are in the financial planning industry, in legal industry, as well as the accounting industry. Wade Pfau, who's written several books now on reverse mortgages. He is a professor of retirement income, and he stated that incorporating home equity into a retirement income strategy can be a wise thing. It can help increase liquidity, further increase net wealth, and also in some cases decrease income taxes. So that was one of his books that he wrote. John Salter wrote the Standby Reverse Mortgages, a risk management tool for retirement distributions. And Barry Sachs is really the godfather of the reverse mortgage research by the financial planning industry. And this dates back to the mid 2000s. And the original white paper that he wrote that really started it all was Reversing the Conventional Wisdom, Using Home Equity to Supplement Retirement Income. I would encourage you to Google these gentlemen and even look into these resources here as well to get additional information. Also, it's nice to get an outside perspective from the financial planning industry on some of the research they've done with reverse mortgages. So the three buckets of retirement income, this is, I won't have a lot of time to go into this, and certainly we're a little behind schedule, but what this shows is how home equity can be placed in the retirement plan to help give individuals more flexibility, more options on how they manage their money in retirement, and giving them one additional bucket to be able to do all sorts of things in retirement, to supplement income, pay for expenses, and even to keep your retirement savings intact to hopefully further grow those nest eggs. So on the left side here, the relationship between monthly income, nest egg, and home equity for many homeowners is as such. You make money, your W-2 wages, and for many people who own a home, they have to put about 30% of their income into home equity bucket. This would be in the form of, for example, making mortgage payments or down payments to buy a house. So about 30% of one's income is placed into the home equity bucket during your working years. And for those who are fortunate enough to have money left over, the financial advising community advises that you put anywhere between 5 to 20% of that disposable income into some sort of retirement plan, whether it's company-sponsored 401ks, stocks, bonds. You put that into your nest egg. And you continue that relationship over time. And then once you get to the right side, which is now in retirement, what happens for many Americans is that their income decreases. They're no longer working as much. They may not have any W-2 income. And now they're left with Social Security primarily, and for some, pensions. So now they're using this fixed income to, for many of them, we learned earlier about 44% of Americans are still making a mortgage payment. So now, once you get to retirement, you're using that fixed income to continue making mortgage payments. And you're still sending money down here to the home equity bucket. But unfortunately for many, lifestyle requirements are making them have to draw from the nest egg because they just don't have enough income coming from fixed income sources to not only supplement what they need to do, but live the kind of lifestyle that they need to live. So what happens is the nest egg begins to get withdrawn. And this is what many Americans do. And not that there's necessarily anything wrong with that, but for many of them, they just have one option, which is just drawing whatever's in the nest egg. Even if the market is down, many of them have no choice but to draw from your nest egg to help supplement income. But if the home equity bucket could also be put in play, then this gives, as I mentioned, homeowners more flexibility and options. Now, how do you put that home equity in play? Well, there's really only three ways. You sell the home to liquidate all the home equity, and now you have it in your possession, but for many, they still got to go find a place to live, and maybe they don't want to move, so that might not be the best solution for many. Secondly, is you can take a traditional mortgage and get cash out, but for many, the issue with that is that now you have a payment or you've increased your existing mortgage payment, which can be counterproductive. And then the third option, for those who are of age, you can obtain a reverse mortgage. And the reverse mortgage allows you to tap into a percentage of that home equity, where with this product, there is no required mortgage payment. So now you have the flexibility of leveraging home equity, using home equity in a variety of different ways without being required to make a payment in return. This can also help you strategize. So perhaps now you don't need to draw as much from your nest egg, and you can allow your nest egg to grow or recover from down markets while you utilize your home equity bucket. There's been a lot of research on this strategy, some by the individuals that I mentioned earlier, and the end goal of what this has been determined to do is that it's going to do three things. It's going to increase liquidity naturally. It's going to help many people further grow their net wealth because they now can put home equity to better use or to work. And in many cases, it can help decrease income taxes because all the funds that you qualify from a reverse mortgage, it's a loan. So it's not considered income. It's not being taxed. And for some of the nest egg accounts, some of those are taxable when you withdraw money. So this can help to save on income taxes when you turn to the home equity bucket. Now, one of the advantages of the reverse mortgage is the reverse mortgage line of credit, the HECM line of credit. And what makes it different from many other lines of credit is that it grows. And it grows at the same interest rate as the loan balance. And this is a part that many people just can't comprehend. How does this grow? Well, it's part of the product. It's one of the advantages of a reverse mortgage line of credit is that it gives you the ability to have more funds available independent of what real estate values are doing. This is primarily just tied to and geared by the interest rate of the loan. So the unused portion of the line of credit, whatever you have not used, is going to grow at the same compounding interest rate as the loan balance. So this can allow you and clients, people you know, to have greater borrowing capacity over time. It's secure. And this is a big difference from traditional HELOCs, where traditional HELOCs can be frozen. They can be reduced. They can be closed upon you for any reason, numerous amount of reasons that the creditor deems necessary. But with a reverse mortgage, because of the insurance, it can never be taken away. It can never be frozen as long as you're meeting your terms of the loan. And it's liquid. Once you put it in the line of credit, it's available. You can access it in a matter of 3 to 5 business days. You don't have to reapprove over the years to gain access to that line of credit. Once you do it, it's in the line of credit and you can use it whenever you'd like. Here's a quick example of how this could work, this growing line of credit. So take a 62-year-old borrower whose home value is $600,000, and it's free and clear in this example. Based on their age, based on the current interest rate, they qualify for a reverse mortgage loan of $214,200. And let's assume that this client didn't have a need for funds at this time. They're simply putting this reverse mortgage line of credit in place for the future. They want to experience the growth so that that way down the road in retirement, they have more funds that they can utilize. The green line here is just real estate values, doing what real estate historically does, which is on average about a 4% appreciation nationally. And the green line is the line of credit, starting here at about 214,000. And as this person gets older, as time goes on, you see that the line begins to take off. And it really starts to take off here in latter years. Why is that? Well, it's compound interest. So the longer that you have a reverse mortgage line of credit in place, the more opportunity that compound interest can work in your favor. And this was one of the aspects of the product that really gained the attention of the financial planning community and how it can be used in different strategies. I don't have a ton of time right now to get into it, but this is certainly something that you really want to look at closely, because as in this example here, when this person reached 89, their line of credit is actually larger than what's in the equity of their home. And at that point in time, at any point in time, they can draw all of it, regardless of what their home value is. Whether their home value is less or more, that line of credit is insured and guaranteed that you can draw from it at any point in time. So this can add what we call a buffer asset to your retirement plan to give you, again, one more option on where is the best place to draw your money and how you can give yourself one more option to further grow that nest egg. So how can reverse mortgages help? Well, we've been talking about, number one, improve cash flow. Naturally, you're taking an illiquid asset, which is real estate, and you're liquidating it via this product. You can also coordinate between spending from your investments and your reverse mortgage. This is what we talked about a little bit ago to help offset income taxes that may be taxable on your investments. Also, maybe the market, it might be down at the moment and it's not a good time to draw from your investments. So you can turn to the reverse mortgage instead. This line of credit that we were just speaking about, it can serve as a standby portfolio protection asset. You basically could just put it in place. You do not need to draw from it. But if a need arises down the road, you have that available. You have it there in case you need it for anything at all. What the research has shown is that this can better protect the investment portfolio from market volatility, a little something that's called sequence of returns risk that happens in the markets, and it's a portfolio risk that a lot of advisors have to tend to, where this can help offset and basically just help your investments last longer, keep more assets in your portfolio while not necessarily decreasing your net worth. So for many, the end result is to take what you have today in retirement savings and stretch that out further to last you a longer period of time when you put a reverse mortgage in place. So that can be very powerful for many people in retirement. The loan proceeds can be used pretty much for anything at all. Medical expenses. We were talking about long-term care insurance, which most people do not have in place at the moment. This could be a source to help put long-term care insurance in place. Of course, things like home renovation projects, any type of large purchases, and again, essentially anything at all. There's no restriction on what you can use the reverse mortgage proceeds for. You can also, for those who are still paying a mortgage, you can refinance your existing mortgage and put a reverse mortgage in place to remove the requirement of mortgage payments, and now have that additional cash flow each month that you can now direct to other areas of your life, whether it's to retain for lifestyle, or what some people have done is take that, whatever that monthly payment is that you were making each month to a mortgage company, and now that it's not required with a reverse mortgage, you can take that money and send it to your retirement savings account and see how that will help your portfolio and your retirement savings. Certainly, for those who have, and there are many right now, who have high interest credit card debts, we've seen those debts skyrocket over the last couple of years at interest rates of 20% plus. this could be a good reason to utilize the funds from a reverse mortgage. Social Security benefits. For some, they might want to hold off drawing from Social Security to get the maximum lifetime benefit. And they take out a reverse mortgage early in retirement to help supplement that income and help them to just be able to afford life until they get to the maximum age of Social Security. Used as a tax management tool to receive deductions when needed. So a hot button is Roth conversions. There is a tax that one needs to pay when you first do the conversion of your investments from maybe a traditional IRA into a Roth. And the reverse mortgage can help many to pay that tax in the year of conversion to then help have the savings in the lifetime with the Roth. Using a growing line of credit to hedge against declining home values. You put a reverse mortgage in place today, for example, and your line of credit is set today on whatever you qualified for today. As mentioned earlier, that line of credit is going to continue growing even if property values begin to decline. So for some, this could be a way to protect against declining real estate values and also buy a new home. Yeah, a lot of people don't know that you can actually use a reverse mortgage to buy a new home. That's called a reverse mortgage for purchase product, which we're going to talk about right now. So maybe that's something that people in retirement, maybe they're living in a house that is no longer suitable, it's not functionable, maybe a two-story home, maybe a lot of land, too much space, and you're thinking about downsizing but not quite sure how you're going to make that work. Well, you can use a reverse mortgage to buy your next home. So in that scenario, the way that would work, give you a rough idea, is that whatever the purchase price is of the new home, of course, based on your age and current interest rates, you're going to make a one-time down payment. In some cases, it could be about 50%. So real simple, you're buying a home with $700,000. You put 50% down as your one and only payment required for life, and the reverse mortgage would finance the other half. And then it becomes, as we discussed, an optional payment mortgage. You decide whether you want to make payments or not, and you retain more cash for your investments than just paying cash for a property and putting all the money into real estate and into the dirt, into the ground once again. You can retain more money for your investments, or possibly even purchase more property, maybe a more expensive home that you didn't think you could afford with just cash alone. So how can you get some more information? If this is something that you would like to learn more about the strategies, learn more about the purchase product, well, certainly you can reach out to those who maybe invited you to this webinar. One of the advantages for our retirement mortgage specialists here at VIP Mortgage is that we have a dedicated reverse mortgage division. We're what's known as a closed loan seller, which means we not only originate the reverse mortgages, but we close them in our own name. We have our own underwriting, our own processing that makes the process very smooth and efficient. Our retirement mortgage specialists are trained and dedicated to work exclusively in reverse mortgages. And we've worked with a lot of retirees to understand the needs and the objectives and how this product can maybe best solve some of those needs that we have in retirement. Of course, we work with real estate agents, insurance and financial professionals, and many other homeowners as well. Our company here offers all reverse mortgage products that are available in America today. We have the unique ability of not only underwriting, servicing underwriting and processing the product, but also being able to offer all the various reverse mortgage products that are available in the marketplace today. So we've got some time for questions, and also, of course, if you're interested in any additional resources or obtaining a summary of what a reverse mortgage might be able to do for you or someone you know, you can reach out to your VIP representative or send us an email as well. You've got my information here that we'll be happy to field any questions, any requests that you might have. We certainly want to be a resource for you and help you however we may. As I wrap up, just want to leave you with a thought that, for many homeowners in retirement, home equity is their largest asset. And the question isn't whether it exists, it's how and when it should be used strategically. We know that a reverse mortgage is not right for everyone, but for the right person in the right situation, it may be a powerful planning tool. If today's information raised any questions for you, or as I said, if you'd like to see more what that might look like in your specific scenario, reach out to us. We'll certainly be able to provide you information, maybe point you to other resources, or even give you a summary of your options if that's something that you would like. Wendy, do we have any questions out there? We've still got some time here. Any questions from anyone in the audience that we can address?
We do, Rick. We have a question. What about folks that have a very low, like a 2.99 current interest rate on their home? How does the second lien product work and what kind of upfront fees go along with that?
Well, the second lien product, that's one of the main reasons it was created, is for individuals who have a very low first lien mortgage and they don't want to pay it off for whatever reason. This product would just go right behind it. So they would continue making their payments on their current mortgage as they're doing. The second mortgage, reverse mortgage, would come in place. What you qualify for, it's based on various factors. It's based on not only age, but the combined loan to value of the first and second mortgage. But roughly, combined loan to value can go up to about 50% or so. It's a newer product. There's a lot of changes that are actually still taking place on the product. But just generally speaking, it would be a second mortgage behind it that at the moment provides a cash out. They're talking about a line of credit option on that, which may be coming here very soon, I'm told. But for right now, it's a lump sum cash. And then you've got the same terms, which are it's an optional payment mortgage for as long as you're living in the home as your primary residence. In terms of fees, they vary. I don't want to quote a fee that is not going to be pertinent to all because it's based on all those factors I just mentioned: age, your loan to value, home value as well.
That sounds good. That sounds good. Okay. And that is the only question right now that has been in the box. So if anyone else is on the call that has any other questions before we wrap up, feel free to raise your hand and holler at it and let Rick take a stab at it for you.
Yeah, I'm happy to do that. I wanted to leave a little bit of time, went through things a little bit quicker than normally just because we were a little behind, which apologize again, but wanted to at least give some time here for any questions. And happy to stay on here for a few more minutes. If not, as I mentioned, reach out to us if we can be of service. There's a lot of information out there, a lot of great information, some misinformation. It's really important that one takes their time in researching this, making sure that they're not stumbling across maybe old information about the old reverse mortgages and how those worked. I've heard a lot of people still to this day who are asking questions about how reverse mortgages work and are thinking that it's still the old product prior to 1989 where the bank took title to the home or the bank took the equity at the end. Those are not the reverse mortgages of today. So again, important to make sure you've got the right research, the right resources in place to help you understand how this product can best work for you or someone you know.
Hey, Rick,
And
it's
Rick,
Tiffany.
I have unmuted, so we are got somebody that has a question.
Yes.
Hey, Rick, it's Tiffany over at VIP, and I've got my parents here, and they had a couple of questions. Can I let them ask?
Yeah, that'd be great, Tiffany. Sure.
Okay, cool.
Okay, if you take a lump sum, I assume there's an interest is accruing on that amount.
That is correct.
And is that what is that rate, and is it fixed or variable?
Well, it depends. There are variable options, which is the main reverse mortgage option, is the variable rate. Right now, variable rates are somewhere around 6%. There is a fixed rate option that is very seldom selected because it's just not priced well right now with the reverse mortgage. And that's closer to about 8% or so. The fixed product does require a lump sum withdrawal, whatever that is. Whereas the variable reverse mortgage, which is the much more popular one, the one that literally right now, it's over 90% of reverse mortgages nationwide are adjustable. And that's for different reasons. Number one, you qualify for more than the fixed. And then secondly, you have those additional disbursement options. Instead of just a cash out, you can also elect a line of credit. And now you've got the benefit of that tool where, number one, while the money's in the line of credit, you haven't borrowed it. So interest is not being accrued against you on that portion because you haven't borrowed it. And then secondly, like we talked about earlier, you're experiencing the growth of that line of credit, the unused portion that you keep in there, which is also growing right now at about 6%. So for those reasons, this is why the adjustable's a much more popular option with reverse mortgages, like a home equity line of credit in some ways.
Okay. Also, I'm interested in the fees you charge. Is there an application fee, and what is it?
There's no application fee that's charged. The
Okay.
charges,
How about an origination fee?
the industry has a standard origination fee. It's calculated by the product, and it is 2% of the first 200,000 of home value, and then 1% for every 100,000 thereafter. And the product has a cap on what lenders can charge for an origination fee on the HECM product, and that is $6,000. That's the most that can be charged. And again, it's based on a percentage of home value.
Okay. How about monthly service fee?
Monthly service fees we don't see with the HECM product. With some proprietary products, the private reverse mortgage that is, you may see a monthly service fee of anywhere from $20 to $30 a month. But it's no longer on the HECM product. It's been many, many years since monthly service fees were charged on a HECM product.
Okay. But if you're interested in the other, what was that called, proprietary, then it would be.
There are some, not all of them, but there are some proprietary products that currently carry a monthly service fee.
Okay, and then the last one, how about other closing costs?
So you're going to have standard closing costs as with any other mortgage, which would be things like appraisal, title charges, recording fee. With the HECM product, you also have an insurance fee, and that's what makes it more expensive than any other mortgage. And that is an insurance fee that goes to FHA. It's a one-time fee that's charged at the closing of the loan. And that currently is 2% of whatever the property appraises for, up to the limit that I mentioned earlier of $1,249,125. So that is the one cost that does make reverse mortgage closing costs more expensive than any other mortgage. Right. However, it's the insurance that makes the product work the way that it does and gives the protections that it does, the benefits, as well as the growing line of credit. So there is an expense. However, if it's valuable to one, that's the offset, is the value that it provides.
Okay, so does that take care of a mortgage insurance premium, right?
Correct. That's what that is. That's a mortgage insurance premium.
So there won't be another MIP added on to what we owe.
Not an initial cost like that. As part of the interest rate, there is an annual MIP of 0.5%, 0.5%. That's fixed for life. That portion doesn't change. So that's part of the ongoing interest rate to continue insuring the reverse mortgage on the HECM, on the home equity conversion mortgage product, the FHA product.
So the HECM does have an MIP at what now?
There's the initial upfront MIP, which is what I was talking about, 2%. That's a one-time cost. And then as part of the interest rate moving forward, there's an ongoing annual MIP, which is 0.5%, 0.5. And that's there for life.
Okay. And that's 0.5% of the
loan
appraised value of your home.
No, that is 0.5% of loan amount.
Loan amount. Okay,
Yep.
Gotcha. Okay, just a few more.
Sure.
How the loan can become due. So if you're late on your taxes or insurance payment, how late are we talking? A day?
No. I mean, this is something where you have to be considerably late. Similar with, other mortgages, or even if you have your home free and clear, obviously if you're behind on your taxes or even an HOA, one could risk foreclosure just even on a free and clear property. But with a reverse mortgage, that is a requirement. What the product will even do, if someone misses a property tax payment and there's funds in the line of credit, the reverse mortgage will automatically pay that property tax from the line of credit funds to bring them current if necessary. So the point is that the reverse mortgage is going to try to do everything it can to help the homeowner cure any defaults with property taxes and even homeowners insurance. But if there is just a string of defaults, and it's kind of subjective because it's case by case on there isn't an exact guideline on how many lates are going to trigger default. It's subjective, but if there's a string of lates, then certainly, and there's no way that they're going to cure it, the homeowner that is, there's no means to cure it, then that can certainly start getting into an area of foreclosure.
Okay, great. Well, thank you so much. You've answered all my questions.
You're welcome. Thank you for the questions.
For next steps, I assume, do you have LOs in the Phoenix office where we actually can physically get together and run the scenarios on their actual property? Is that the next step?
Yes, we've got LOs. We of course want to have a reverse mortgage specialist LOs to walk you through that, and we have those that can do that, whether in person or from afar, and we can certainly talk about that. Just reach out to me personally and we can talk more about that.
Awesome. Thanks for your time. We appreciate it.
You're welcome.
I'm going to take a picture.
Well, if we don't have any other questions, Wendy, I think we're good for the day. I think we've accomplished what we came to accomplish today.
That is all we have, Rick. Thank you so much for your time and for all the great information.
Wonderful. Thank you, and thank you all for joining. We'll see you soon.
Have a great day, everyone.